Good day, everyone. This is Patrick from EasyFX Code Trading System, and it's Saturday, the 4th of February, 2023, and this is the weekly technical analysis for the Euro, the Cable, and the Aussie dollar for the second week of February. And if you look across all these three major pairs, and as well as you'll see later on for my other video for spot gold, all the major currencies against the US dollar has taken tumble over the last couple of days of the week. And a major tumble with a significant retracement. And we'll see whether it's going to continue for next week. And we'll look at the causes of that with the three central banks reporting last week, and as well as the review of the US dollar index. Okay, so let's start off with the Euro. So on the Wednesday, there was the Federal Reserve's announcement for their rate hike of 25 basis points, followed by the Thursday, the ECB reported and announced their rate hike of 50 basis points. And then on Friday, there was the US non-farm payroll report, and as well as the ISM services PMI. So these three were the main triggers for the movement, in fact, for all the major pairs and the US dollar. So the Federal Reserve reported on the Wednesday, highlighting that they're still concerned about inflation, and they're going to, that's their main focus, but the market was ready to accept the interest rate hike in the next meeting in March, and perhaps maybe a pause. And then on the Thursday, the ECB announced their rate hike, but they did have even worse inflation issues to contend with. Their inflation did decline from a high of 10.7% and fell to 8.5% now, but still high, so that's still a concern. And they were going to look at the potential a few more hikes, at least two, probably March and then May. But the tone was dovish, so that's why the Euro started to fall after spiking through the resistance zone at 110, spiked through to hit 110.40 area, 110 high 110.33 before getting rejected and pulling back. And then it was worse and triggered by the non-farm payroll report, which came out much higher than expected at 517,000 jobs added, way higher than expected of about 190K. So this was a concern that the economy or the jobs is adding, is still hot, still running hot, and this may contribute to additional wage inflation cost. So that's fuel some concerns that the Fed may add on another rate hike perhaps in May, which they did say that they were looking at terminal rate of about 5 to perhaps 5.25%. And then additionally, an hour and a half later, there was the ISM services PMI, which also came out higher than expected at 55 versus expectation of just 50 or 50.5, and or was better than previous month where it fell below 50, and 1 month dip to 149.6, and this added more fear that the Fed could tighten further with additional rate hikes. So this triggered further sell-off in the markets. So now the bearish move could continue through next week, and in the interim support at 138.5 extension here may not hold and could drive past to the 107 area. So 110 is definitely a strong resistance up here. And if it's really weak, then it could even fall further down into the next support zone, a key support zone at a 105, where the daily 200 EMA is climbing into. And this was where the recent run started from after hitting the swing high here. And it bounced off to all the way through to the 110. So let's see if it's the 107 can hold, and perhaps maybe slightly lower down to the daily 55 EMA. But if it does break through the 55 EMA, then it could very well target the next key support zone. On the weekly time frame, you can see that a strong rejection here with the long upper wick and forming a very ominous looking shooting star on the weekly time frame. So that could definitely be a bearish continuation move for next week and perhaps the next couple of weeks. So we'll see. No major news this week for the Eurozone, and as well for the US economy as well. So it will be basically just technically driven. All right, so let's also compare this and take a look at the US dollar index. And here's the US dollar index, the DXY. And as an inverse correlationship, as last 2 days of the week, the US dollar has rebounded, found support just below the 101, but did not reach a 100 round figure, dipped down to a low of 149 and recovered on the Thursday, and then a big move on the Friday with the non-farm payroll report and the ISM services PMI's figure. So it has eventually now climbed up through the 138.5 extension and targeting the 103 round figure. So this is now the intermediate resistance at the 103 and coming up towards the daily 55 EMA. There was a swing low from the past. Let's go to the weekly, and it was a swing high with this double test here. So let's see if it can reach that level and climb through it. That's just above the weekly 55 and on the daily 55. So that's a critical level here. That's at 103.74. If it can, then it's going to climb up towards the previous swing low here at close to the 105 region. That's going to be a critical resistance zone here. At the 105. So we can mark the support. Let's mark the support zone here. That's a key support for now. And we know below that at the 100, that's the already the critical one. Okay, which align with the 162 fib extension of this swing move down. Now we could also let's take a look at the weekly time frame first, and yeah, that was a spike through the 101 and managed to climb back up, trying to climb up into the weekly 55 EMA, just above 103. Now we could also just update this fib to show the retracement from this recent move down. Okay, and that's trying to climb back up towards the 50 fib retracement, which aligns with the 103. So that's a good confluence area. And then if it does break through that, that's above that, that's the 62 fib retracement. Okay, so in the near term, let's see whether we can climb up towards the 62 fib and as well as the previous swing high and also the daily 55 EMA confluence all around the 103.80 area. Okay. So in the short term, it's US dollar is turning bullish and rebounding, but it needs to break through a couple more resistance zones to really recover, because this recent fall is a significant fall and needs to get into the 105 region and see how it reacts there. Okay, so let's move back to the other major pairs. Okay, let's move on to the cable. And the cable has also suffered over the last couple of days and falling over 300 pips. And similarly, on the Thursday, the Bank of England did announce their rate decision, which was increasing by 50 basis points, similar to the ECB, but to a higher rate now. Their rate is at 4%. And also probably projecting another couple more rate hikes in March and May. And highlighting some strong headwinds as their inflation is even higher. Hit a high of 11, just over 11%, and now just dipping lower to 10.5%. So the UK economy side is definitely struggling a bit more. And added with the Federal Reserve and non-farm payroll report and the ISM services on the US side that triggered a further fall in the pound and driving it down towards the 1.2 round figure, which is not very far away, only 50 pips away, and likely heading down towards the 38 Fib retracement and into this swing low area where it started its move higher. It could not get through this December swing high, so it couldn't hit the 125 round figure, which will be a major resistance zone, resistance level. So there is UK GDP numbers coming out this Friday. So we'll see if that's economy is doing well on the weekly time frame. It looks like a very ominous looking evening doji star, and dipping, threatening to dip down into the 38 Fib retracement area. So yes, it needed to break above the 125 in order to turn more bullish and attempting to break through higher these previous swing lows. But it was unable to do that and has quickly retraced lower. Okay. So yes, this retest of this December high has created a double top formation, and this is threatening to drop into that neckline, and we'll see if that area will hold, and we'll see whether it's going to continue to target down into the 50 Fib retracement area, which could align with these previous swing highs here. Okay, let's mark this one here. And I think we can remove this now and add that to the 50 Fib zone. So that's another critical support. We should provide enough support, but it could be an intermediate one, so we'll see. So the 50 Fib retracement is at the 116.85, so just below the 117 round figure. Okay, so let's move on to the Aussie dollar. And similarly, Aussie dollar has also a similar reaction with Wednesday, took advantage of the weaker US dollar and ran up to test the resistance zone that we marked last week. Was rejected, and then a sharp decline on the Friday of over 150 pips. So right through the 70 round figure, Let's remove that now. And so the next key support is into this 200 EMA and the 55 EMA converging. And that's near the 68.60 area. And close to these swing lows here, as well as this swing high area. So within that zone, that's going to be a critical support. On a weekly time frame, right? That's a very bearish engulfing candle, and right into the weekly 200 EMA that we highlighted, that has a confluence with this previous swing low, and that's where it hit and was rejected. Now, if it does dip lower, perhaps we can just leave this. And if it does dip lower, there's the previous swing high here at this 100 Fib, which aligns or confluence with the 68 round figure. So if it does turn more bearish, there could be additional move down into the 68 zone. Okay, let's check the weekly time frame again. Yes, that's a possible area of support. Okay, and Tuesday it's the RBA's turn to announce their rate hike, and they are expected to increase rate by 25 basis points. And the Australian economy should be growing with the opening of China, so there could be less impact of the need for further tightening. But this is all a reaction against the US dollar index. So we'll see how far it's going to fall as well. Okay, so do check out my other videos on spot gold and dollar yen. Have a safe week and a good trading week, and cheers for now.